After 21 years being fully invested in the stock market, I've seen a lot of market drops. But if there's one thing that helped me stick to my strategy and stayed invested was the fact that I knew that my dividend was safe. In fact, in 2003, the first stock I bought was a dividend payer, which I would call a deluxe bond today, and it was Power Corporation. So what's a deluxe bond? Well, a deluxe bond is a stock where I don't expect much price appreciation, but that I know that the dividend is generous and the dividend is safe. In other words, this type of company is like a bond, but just better because the dividend will increase and eventually the stock price will give you a little bit of total return. After seeing Canadian Natural Resources and Fortis increase their dividend lately, I decided to talk a little bit more about what they have in common and the three characteristics that would create those safe dividend stocks. So the first characteristic is to have a stable business model. In general, deluxe bonds will be kind of like boring companies with predictable cash flow, but that's pretty much what you want. You want a company that you can put in a box and forget for the next 10 years, and still this company will be operating. When you look at Fortis, it is a utility company providing power. They have 99% of their assets that are regulated, which means that they operate on a specific territory and they negotiate the rate with regulators. As you can see, between 2020 and 2023, the company was able to increase the rate by 6.5% every single year. At the same time, the earnings per share grew almost as fast as 6%. In other words, Fortis' business model enables the company to benefit from steady rate increases that translates almost automatically into more profit. When you look at Canadian Natural Resources, it is a vertically integrated oil and gas company. The fact that it is sitting on high quality oil sand assets makes them able to increase the production when commodity prices go up. And when they go into a down cycle, they just slow down the production and just wait until the cycle becomes anew. This type of business model protects CQ from heavy fluctuation and also enables them to pay down their debt, increase their dividend, and buy back their shares whenever the oil price goes higher up. The second characteristic of deluxe bonds is they have a proven record. It's all great to have a good narrative and a good story behind a business model, but then what happens when the company must face challenges? When you look at Fortis, the company has been able to increase its dividend for 51 consecutive years. They went through all economic cycles, several recessions, several market crises, and yet they've been able to increase their dividend by almost the same rate. So between 4 to 6% dividend growth increases year over year, offering a generous yield of around 4%. When you look at CNQ capital allocation over the past 25 years, it's a little bit more complicated. So from time to time, you see that there are a lot of share buys back, but every single year, the company find enough cash flow to increase its dividend. Actually, it shows 24 consecutive years with a dividend increase, and 2025 will mark the 25th consecutive year with a dividend increase. For an oil and gas company, that is quite a record. Speaking of companies increasing their dividend every year, I invite you for my next webinar on November 28th, Dividend Income for Life. We're going to debunk the myth of high-yielding stocks. We're going to focus on high-quality income. I'm also going to provide you with a portfolio retirement example. And finally, I'm going to show you how you can create your dividend income for life. You can register in the link description below. There will be a free replay sent to all registered attendees. And the last characteristic to become a great deluxe bond in your portfolio is a company showing revenue, earnings per share, and dividend growth over a long period of time. And on top of that, offering a nice yield. By nice yield, I mean something around 4%, maybe a little bit more. But the key component here is to be able to grow the dividend and beat the inflation. When you look at Fortis, you can see that their dividend triangle, including the three metrics, you see revenue going up, you see earnings per share going up most of the time, and then the dividend has grown for 51 years. So on top of that, with a 4 to 6% annualized increase, you surely beat the inflation with Fortis dividend. As for Canadian natural resources, of course, when you look at the dividend triangle, the revenue and the earnings, it's a little bit shakier, right? It goes through cycle, and whenever commodity prices goes down, as I explained before, the companies slow down the production and just wait for the next up cycle. Whenever there's a high cycle and the price goes up, well, this is where you will see share buys back, debt payoff, and of course the dividend increase. What is great about CNQ is that they has been able, with their stable business model, to go through a lot of energy bust cycle and still fulfill their promise to their shareholders. So while picking safe dividend stocks seems like the perfect solution, sometimes the deluxe bonds could be quite frustrating. If you look at CNQ's stock price graph, you will notice that while it goes up and down, it has produced absolutely no return for 10 years. That's a very long time to wait, and this is also why I call them deluxe bond. So you have to know the role in your portfolio. It will not bring your portfolio value skyrocketing and providing you with high total return, but they will bring an element of stabilization with their steady dividend payment that is increasing, and of course that are quite generous. In fact, in a perfect world, we would all invest in great companies with a stable business model, a strong dividend triangle, on top of having a 4% yield that is increasing more than inflation. Unfortunately, this type of businesses is relatively rare. So I'm curious to know, what is your favorite deluxe bond? So a company showing a stable business model that has a proven track record and also shows a robust dividend triangle with a 4% plus yield. Let me know in the comment. I'll see you there. Do not forget to like and subscribe to this channel. And until the next video next Thursday, don't forget to stay invested.